Good evening, Tamil. How are you? Yeah, I'm also good. How was your weekend? Good. Okay. So I'm just waiting. I just want to see for 1 or 2 minutes if there are any more students coming or not. So I'll just wait for a while. Okay, Tamil, I'll just wait for 2 minutes. Good evening, Samuel. How are you? Okay, I'm also good. All right. So we can now start off. So today we are going to discuss about financial decision making and financial management basically. How is it done? Okay. So the first thing that we will be discussing is the meaning of the financial management, scope and objectives. The financial management is it's also known as FM. So FM may be defined as the art and the science of managing money. It involves art as well as science. Why is it an art and science both? Because uh, it is science because we make use of these set laws and rules and regulations which are there. Okay, so it's a science, and it is an art because it depends on the person how he is going to implement those principles and come to a concrete decision making. Okay, so that is why it's an art, and this varies from person to person. It depends on the skills of an individual. So from that aspect it is an art. So we mainly study the duties of the financial managers of a business firm. So we can see what are the decisions of what are the areas of financial decisions: investment analysis, working capital management, sources and cost of funds, means from where are we going to get the money to finance the business. Determination of the capital structure, how much will be the different types of capital, like how much will be the called up capital, how much will be the paid up capital, that all. What will be the dividend policy of the company, what is the and the analysis of risk and returns. So in support, there are some primary disciplines and some other related disciplines, and they all together, the purpose is the shareholders' wealth maximization, because shareholder is the owner of the company. So if he is not getting the adequate returns or pleasing returns, then he will not be willing to stay with the company. He may just sell off the share and move, and if there is sale of share, then the value of the company in the market goes down. So to please the shareholder, every company aims at the maximization of his or her wealth. So there are two different approaches to this financial management scope. One is the traditional approach and the other is the modern approach. Now let's see what are these. The traditional approach is also known as the corporation finance. And in this, the three related aspects of raising and administering resources from outside. There are three things which are considered in this. The first is the institutional arrangement in the form of financial institutions which comprise the organization of the capital market. The second is the financial instruments through which funds can be raised, like whether we are going to issue shares, whether we are going to issue debentures or equities, whatever, the different instruments which we can use to raise the funds. So that all planning is needed, when they will be issued, how they will be issued, and what will be their value and everything. Then the legal and the accounting relationship between a firm and its sources of funds. So these three things were looked up under the traditional approach. But now the time has changed, and now we use the modern approach. So modern approach is just a broader concept as compared to the traditional approach. So we can see in the traditional approach, it was the outsider looking approach. Means we were concerned about the third parties, the people who have invested the money in the business, but we were not very much concerned about the people who are the owners of the company or who are working for the company. So this was one limitation. Then there were many other limitations. You can just read it, and then I'll be taking you to the next. Okay, so you are done with this, hopefully. So I'll just go to the next. Tamil, did you read that? Okay, so now next is the modern approach. In this, the financial management is covered in a broad sense, and it provides analytical and conceptual framework for financial decision making. So the principal contents of the approach are: how large should be an enterprise, how fast it should grow. Like we have certain parameters. When a baby is born, it is expected that if the baby weighs around 3 kgs, then it's a good enough weight. Then, like within the first 3 months of his life, the baby should put on weight, and that, like, it is a predetermined value. It should be like between 2.5 to 3 or something like that. So similarly, when a enterprise is set up, it is expected that within the next this span of time, maybe 5 years or 10 years from now, it should grow this much. Like its profit should be in this proportion, its size should be in this proportion. That all is predetermined under the modern approach. In what form should it hold its assets? Then what should be the composition of its liabilities? Means how many shares should be issued, how many debentures should be issued, and all that aspects are covered under the modern approach to financial management. Alright. So the functions of finance under the modern approach are three types. The one is investment decisions, the financing decision, and the dividend decision. And these three are equally important. And in the next 2 PPTs which I have uploaded, we'll be discussing about the investment and the dividend decisions in detail. So what is the organization of the finance function? You can see there is the BOD, then there's a managing director or chairman, vice president, finance, chief finance officer, there's a treasurer, there's a controller, then there are managers under the different heads: capital expenditure, financial planning, cash manager, credit manager, foreign exchange, pension fund, tax manager, corporate accounting manager, cost accounting, financial accounting. So you can see even in the accounting there are three types of managers. One is for corporate accounting, then cost accounting and financial accounting. So it's the scope of this is really very wide. So now the first is the investment decision. So investment decision relates to the selection of the assets in which funds will be invested by a firm. So the assets which can be acquired fall into the two broad categories. Means how a firm is going to invest its capital. In what type of properties is it going to invest, and when and how. One is the long-term assets, that is the capital budgeting. Then short-term or current assets, that is the working capital management. Capital investment is the one which is done for a long period of time. Can you give me an example of the capital investment? Tamil and Samu. Building, okay. Machinery, building, then plant if it is set up. So all those are and working capital is the capital or the amount of money which is needed for the day-to-day transactions of the company. So these two will be taken care of in this investment decisions. Yes, petty cash. Next is capital budgeting. It is the most crucial financial decision of the firm. It refers to the selection of an asset or investment proposal or course of action whose benefits are likely to be available in future over the lifetime of the project. So it's like capital decision making only. It's how choice of the new assets out of the available alternatives, or relocation of the capital when an existing asset fails to justify the funds committed. Like if we are investing, if it's a big hospital, if it's a big hospital setup and we are getting all sorts of machines, ECG machine, X-ray machine, mobile X-ray machine and different types, whatever are needed, and if the investment is coming around in all, the total investment comes up to around say 5 crores, and the returns are not enough. Means people are not coming to the hospital, the turnover is not good enough. In that case, the capital which has been invested is not justified, its investment is not being justified. So in that case, we'll have to think of some alternative. So this decision making is based on risk and uncertainty. An analysis of these two things are done. Then the concept and measurement of the cost of capital. Now working capital management is concerned with the management of the current assets. The key strategies and considerations in ensuring a trade-off between profitability and liquidity is one of the major dimensions of working capital management. Means we should never get short of funds. The firm should always have cash available. So cash in hand should be how much cash in hand has to be maintained, how much should be kept in the petty cash account. That all decision comes under the working capital management, that is WCM. Is it clear? Tamil and Samu? Tamil, are you getting it? Okay. The next is the financing decision. It is broadly concerned with the assets, mix or the composition of the assets of the firm. Then a capital structure with a reasonable proportion of debt and equity capital is called optimal capital structure. Means there should be a balance between the debt and the capital. the creditors and debtors of the company should be in proportion to each other. The company should not have too many creditors, neither too many debtors. So in this we study the capital structure theory and the capital structure decision. We go by this. The next is the dividend decision. Dividend is a very important part of company's financial management. Why is it so important? You know what is dividend? Samu and Tamil, you know the meaning of this word? Dividend? Share. Yes, it is a return on the shares which is uh, given by the company. It's the return on the shares. So why will people invest in the company? Why will they buy the shares of the company? They'll buy the shares only when being attracted by the dividends of the company. If shares are giving them good dividends, only then they'll invest in the company. So that is why dividend has to be very clearly monitored, very carefully monitored. They can be retained in the business itself, means the profits of the company, and they can either be given to shareholders in the form of the dividends. So the decision as to which course should be followed depends largely on the significant dividend decisions. That is the dividend payout ratio, which means what proportion of the net profit should be paid to the shareholders. If we are going to, if we are having a profit of 50%, then how much should be given to the shareholders and how much should be retained by the company? That all should be decided well in advance. Now, what are the objectives of financial management? There are two main objectives. One is profit maximization and wealth maximization. Now, what is the difference between the two? Can you just tell me? Profit maximization and wealth maximization. Yes, Tamil and Samu. Is there a difference between these two, profit maximization and wealth maximization? Okay, it's complicated to narrate. Alright. So, profit maximization is, we can say, a short-term objective, and wealth maximization is comparatively a long-term objective of the company. So profit is the test of the economic efficiency. It leads to efficient allocation of resources, as resources tend to be directed to use which in terms of profitability are the most desirable. So financial management is mainly concerned with the efficient economic resources, namely the capital. So this is important, means we have to maximize our profits, otherwise we will not survive in the long run. Then wealth maximization is also important. If like the firm is having one branch, then maybe 10 or 12 years down the lane, it should have another branch, or it should have some diversification. If it's into the manufacturing of a deodorant, then it should, by that time, it should diversify its operations, and it may just jump into the manufacturing of creams, face powder, such things. Okay, that is diversification. When you when you diversify your operations, means you start manufacturing a related product. So there should be something like that at the end of a specified time span. So this is wealth maximization is also known as the value or net present worth maximization. So its operational features satisfy all the three requirements of the financial course of action, namely the exactness, quality of benefits, and the time value of money. So there are two issues. One is there should be focus on stakeholders. Stakeholders include the groups such as employees, customers, suppliers, and creditors, owners, and others who have a direct link to the firm. Then economic value added is equal to the after-tax operating profits of a firm less the cost of firm to finance investments. When we deduct the tax from the profits of the firm and less the cost of the firm to finance investments. Means if we are taking loan from the bank, we have to pay interest to the bank. So that interest is the cost of the finance. Okay. So that all should be deducted from the profits. So you can see here is a case study of Reliance Industries. So Reliance is an industry that contributes to the economic and social need of India and attaining global leadership in all its major initiatives. Yes, in the recent years, we can say in the time span of just 5-7 years, this industry has grown to massive heights. And now it has got a very important say in the economy of India. It cannot be overlooked. So this is the case study of it. So pursuing this vision strategy of Reliance for the next few years means what are the things they are going to do in the coming years. Okay, just read it. Read these points, then I'll take you to another PPT. Please read it. Okay. This is the end of this PPT. So now we go to the next one, that is on dividend decisions. So we have seen that dividends are very important for a firm. So how these decisions on dividends are made, that we are going to see. So what is the meaning of the dividend? It is the part of the profit which is distributed by the company amongst its shareholders. So it is the reward of the shareholders for investments made by them in the shares of the company. Yes, they buy the shares. Why do companies sell shares? What is the purpose of that? They need investors. Okay. Capital money. Yeah. They sell their shares so that they can get funds from the public. So this public, those who buy the shares of the company, what do they get in return? They get the dividend. And dividend is always paid out of the profits of the company. In case there is a loss, no dividend will be paid for that financial year to the shareholders. So that is dividend. Is the PPT uploaded at your end? Can you all see the next slide? Samu, Tamil, can you see the third slide? Okay, but at my end it's not uploaded yet. Just a second. Still it's not uploaded. Okay. Why, Samu? Why do you have to log out? What happened? Now what we are going to discuss is really important. Investment decision and dividend decision. That is the main part of the class. What we were doing till now, that was just the introduction to the topic. Okay. So let us just continue with this. The next thing, that is the investment decisions. So what are the things that we are going to cover here? These are the topics. Oh, sorry. Okay, so what is investment? It refers to the purchasing of the productive capacity or the capital expenditure. If we purchase a home, then that is a investment for us. If we purchase a property, if we purchase a piece of land, that is an investment. We are purchasing it for the purpose of earning more money in the future by reselling it, or maybe we can build a home on that land and live in that. So investment means how much are we going to spend on the capital property. Then that is spending by a business to buy the fixed assets. Examples, property and vehicle. The things which are needed for the smooth operation of the business. Now why do we need to invest? We need to invest because the business has to grow, and they might just want to increase the capacity so that they can produce more. And if they produce more, then they can sell more, and then that will increase their sales revenue. They could also look to invest to increase the efficiency of their operations. Like right now we are using a machine which can produce 50 units in 5 minutes. And we now the sale has, if we have to increase our sale, we'll have to increase the production, and for that we can just buy a new machinery which might just manufacture 100 units in 5 minutes. So that is now we are trying to increase the efficiency of the operation. Previously, banks and everywhere, there was mechanical counting, the manual counting was there, and now that all has been replaced by computers. So computers are now used to increase the efficiency of the operations of any organization. So this all is the need of the hour which is needed. Okay, Samu. Alright. So next is investment appraisal. Appraisal means increase in the value of anything. Tamila, are you there? Okay. So investment appraisal is the increase in the value of investment. Now what does this actually means is it looks at whether an investment project is worthwhile or not. So can be used for all types of investment, from the purchase of a new piece of machinery to a whole factory. Means from a single unit to multiple things. We can use such investment appraisal policy. Suppose you may just get, if you do not register your mobile number at DND, that is do not disturb service, then what happens is in a day you get at least 3-4 calls from the company, whose SIM you are using, and they come up with an offer like, this is the offer for the day, you can take this is the SMS pack for today, this is the talk time, everything. So do you just go and blindly take that offer? Do you take that? No, you don't take that offer, because what do? You first consider it, whether it's worthwhile or not. Similarly, in investment also, we have to consider the appropriateness of a project. Like if we are investing 5 lakh of rupees in this machine, is this machine going to give us ample returns? Means can we just manufacture units from it that can be sold in the market and 5 lakh rupees realized? So that all is very important. Now what are the financial techniques of investment appraisal? The first is all cost and revenue can be forecasted accurately for future years. Then key variables like interest rates will not alter, and that the business will be looking to maximize the profits. So these are the assumptions on which this investment appraisal decisions are made, but actually they are very untrue. Can you just believe that costs and revenue can be forecasted accurately for future years? The cost of raw material may just go up, the rent of the building may increase, the government may increase the cost of electricity per unit. So that all is just very untrue. Now key variables like interest rates will not alter. Why will the interest rates not change? They will change from time to time. So this process is based on very wrong assumptions. Yes, we cannot find the accurate thing, but still we have to like give importance to it. Now what are the problems with the forecast? They can be competitors with new products, and the prices may keep on changing. Taste and fashions may change, causing an unexpected slump in demand. The economy may change either upwardly or downwardly, recession or boom. Then costs can be affected by inflation and import prices. So that all is there. So these are the fluctuations which a firm might have to face. Now there are different methods or approaches used for this. The first is the payback period, then accounting rate of return, net present value, or discounted cash flow. Okay. So the first is the payback method. Now what is this payback method? Let's first discuss what is the investment appraisal. It means the idea is that if you invest on the future, you will have more incomes coming into the business. So it looks at the comparison of the future incomes with the cost of the initial investment. Like if I'm investing 5 lakh rupees in a machine, how much return should I expect from it in the future? Like should it yield me satisfactory results or not? That should be considered. The first is the payback method. So this payback method says this looks at how long it takes to pay back the initial cost of the investment. Need to know how much revenue the asset will generate. For example, if a machine costs £50,000 and it produces items 50,000 that retail for 50 paisa each. So 50,000 items it is manufacturing in a year, and 50 paisa is the cost of one item that is sold in the market. So it will take 2 years to pay back the initial is how we are going to come to a decision that whether we should invest in this machine or not. Okay, so this is called the payback method. So in the payback method, what we basically look at is how much time will it take to realize the initial amount which we have invested in the particular project or a particular machinery, particular property, asset. How much time will it take to recover that? Okay, once that is recovered, only then we can think of getting profit from it. Okay, Tamil? Yeah. Yes, Tamil. Tamil? Okay. So the first is the payback method. This allows you to compare the projects. So which one takes the shortest time to pay back the initial investment? That we are going to choose. And sometimes it may just take less than a year. Now these are the advantages and disadvantages of the same. Just a second. Can you just read this? Okay. Now the next method is an average rate of return. So it looks at the profits generated by the investments compared to the cost of investment. It's more or less the same thing, but the approach is different. The formula is ARR into 100. ARR is the average rate of return. So first we find the average rate of return, that is average profit upon the initial cost of investment. Like the profit which we are expecting from that machine is or from the sale of those goods which are manufactured using that machine is 5,000, and the cost of initial investment is 50,000. So 5,000 upon 50,000 into 100. So we'll get an answer in what? In percentage, and then we are going to decide how much are we going to invest. What are the disadvantages and advantages that is given? It looks at the profits. It's easy to compare with other methods of investment. Now disadvantages, it only looks at the average profit. It doesn't look at the timings of payment. Means how much time is being used to get to that level. The next is discounted cash flow method. Now this considers what money will be worth in the future. So discounting, it reduces the value of future earnings to reflect the opportunity cost of an investment. You understand the meaning of opportunity cost? Opportunity cost is the cost of next best alternative. Okay, like suppose you have 100 rupees in your pocket, you go to the market, so you can just buy a pizza from that 100 rupees. You can get a burger, you can watch a movie, or you can buy a CD, a musical CD. So suppose you decide to buy the CD. So what is the difference between the satisfaction which you get from listening to that CD and by the consumption of that pizza? The difference between the two, that will be the opportunity cost. So net present value, it takes into account the inflationary pressures and the interest rates, and that is very important because every economy is subjected to inflation. No economy is certain. So that is very important to be taken care of. Then the idea that the money increases in value looks at how much you would need to invest now to earn a certain amount in the future. It allows the comparison of an investment by valuing all cash inflows from the investment. So this is just the basic point. This is the formula for the net present value. Its present value is equal to future value upon 1 plus I raised to the power n. This I stands for the interest rate. What is the interest rate prevailing in the market right now? That is the interest rate. N is the number of years. Okay. It's a mathematical calculation that will be done by the financial experts to give us a concrete idea. Now, advantage and disadvantages, you could just read it. So now we come to the summary of this. So investment is the process of purchasing the fixed assets in order to increase the capacity of productivity. Investment appraisal techniques aim to assess the financial feasibility of investment options. Investment appraisal techniques are based on a number of assumptions which may not be true. Payback method looks at how long will it take to pay back the cost of initial investment. Average rate of return looks at the percentage rate of return on the investment. Discounted cash flow, that is net present value, looks at the present values of any future revenues from the investment. And qualitative factors also affect the investment decision making. That is it. Now we go to the PPT which we were doing previously. Okay. So dividend policy and the significance of the dividend policy. I told you about dividend. Now we go to the significance of this. So it refers to the policy that the management formulates in regard to the earnings for distribution as dividends among the shareholders. It determines the division of earnings between the payments to shareholders and retained earnings. Means how much are we going to, what portion of our profit are we going to pay to the shareholders as dividends, and how much are we going to save for future in the form of retained earnings. Okay, so that all is will be covered under the scope of this dividend policy. Now, what is its significance? The firm has to balance between the growth of the company and distribution to the shareholders. How can the company grow? For growth, lot of investment is needed. If we have to purchase a new machinery, if we have to employ more laborers, if we have to purchase a new premises, for everything, any kind of thing, investment will be needed, and that investment cannot be done by the entrepreneur out of his own pocket. So that investment will be done with the help of the retained profits, means the profits which have been saved over the years. That may just accumulate into a huge amount of money, and that may be invested for the growth of the company. So there has to be a balance between that. It has a critical influence on the value of the firm. Yes, if our dividend policy is not properly designed, if we are overpaying to the shareholder, then as a company we will be in loss. If we are underpaying them, then the shareholders will not be happy, and the goodwill of our company will be affected by this. So we have to strike a balance. Otherwise, the value of the firm will be influenced. It has to also to strike a balance between the long-term financing decisions and the wealth maximization. That you have understood already, wealth maximization and profit maximization. So the market price gets affected if the dividends paid are less. So retained earnings helps the firm to concentrate on the growth, expansion and modernization of the firm. That is why retained earnings are very important. To sum up, to a large extent affects the financial structure, flow of funds, corporate liquidity, stock price, growth of the company and investor satisfaction. So everything has to be taken care of. Now, what are the factors which influence the dividend decisions? First, stability of earnings. Just read it. Samu and Tamil, just read that. The factors which influence. Okay. Now, stability of dividends or the regularity. So it is a desirable policy of the management to distribute the shareholders a certain percentage of earnings as a reward for the investment. It may not always relate to the earnings of the company. So now these are the different types of practices which the company may follow. First is the constant dividend per share. This is the traditional approach. means 9 rupees per share. That may be the approach. Then constant percentage of net earnings. If the earnings are 50 lakhs, then maybe 5% will be distributed as dividend to the shareholders. That small constant dividend per share plus the extra earnings. Then dividend as a fixed percentage of the market. These are different approaches which can be used by the company to pay dividend to its shareholders. Okay. Different modes of payment. Now, what is the significance of the stability? It boosts the confidence of the shareholders, investors' desire for current income, then institutional investors' requirement. Stability in market prices of shares is maintained. Raising additional finances can be met out of like if the company holds a goodwill. Then spreading of ownership of outstanding shares. It reduces the chances of the loss of control. Market for debentures and preference shares is more wide if there is stability in the payment of dividends. Now these are the different types of dividend that can be paid. One is the scrip dividend. This is an unusual type of dividend involving the distribution of a promissory note that call for some type of payment at a future date. Okay, like you might have heard about bills of exchange which are used in international trade. So that type of a thing, a promissory notes may be written by the company in the favor of the shareholder, and the shareholder can present it before the company and he may get the payment at a future date. Okay, so this type of dividend is called scrip dividend. Then bond dividend is in which the company pays a bond, it signs a bond rather, I can say. It's a type of liability dividend paid in the dividend payer's bond. Okay, they sign up a bond that we'll be paying you. Then property dividend is in this a stockholder dividend paid in a form other than cash, scrip or the firm's own stock. Means they'll not get cash or scrip. They are going to get some kind of property. Okay, such type of dividends are offered only by very huge firms, an industry like Reliance Industry only. They can offer such type of dividends. An ordinary firm cannot afford such dividends. They cannot give property to their shareholders. Can they do that? Tamil and Sam, are you there? Okay. Then cash dividend is the normal dividend. It is the cash paid to the shareholders out of the company's current earnings or accumulated profits. Then debenture dividend is sometimes instead of making a cash payment, the company may issue a debenture to the holders. You understand debentures? Debentures are like, we can say, the people who hold the debentures, they are just like the shareholders of the company, but the difference is that those who have the shares, they are the owners of the company, and those who have the debentures, they are not the owners of the company. They don't have ownership rights. They just owe. They will just be paid interest on that debenture. Okay, so debenture is another form of raising funds. If like the company has a limit of shares, like suppose it can issue 1,000 shares and 1,000 shares have been issued, still the company is not having the enough funds. Then what they are going to do? They are going to issue debentures. Debentures are also like shares only. They are also the paper in forms of paper only, but the debenture holders do not have ownership rights in the company, and the return that is paid on the debenture is the interest, not dividend. Okay, and moreover, dividend is paid only if the company is having profit. If the company is having a loss in a particular year, it will not be liable to pay dividend to its shareholders. But for debenture, the interest has to be paid. Whether it's a profit or a loss, the company has to make the payment of interest on debenture to the debenture holders. Alright, Samu and Tamil, you understand the difference between the two? Dividend and shares? Then bonus share. What is this? In this, a dividend payment is made in the form of additional shares rather than a cash payout. Like if a person is having 10 shares, then if a person is having maybe 10, I say 50 shares, then the company may have the policy that on every 10 shares, they are going to give one extra share to the shareholder. So if a person is having 50 shares, he will get 5 extra share on those shares in the form of dividends. Okay. Then optional dividend is the one in which the shareholder can choose to take as either cash or stock. It is his choice. If he wants cash, then cash. If he wants some other form, then some other form. So these are the different types of dividend. Now, what is the objective of stock dividend? Stock dividend means dividend apart from cash. So it is, first is the conservation of cash, the lower rate of dividend, financing the expansion programs, then transferring the formal ownership of the surplus and reserves to the shareholders, enhanced prestige, widening the share market, and true presentation of earning capacity. These are just a few points which I mentioned over here. Just read this one, merits of stock dividend. I think it's done now. Now, demerits of stock dividend is are these: to the company, it increases the capitalization of the company. It results in more liability. It denies other investors to shareholders. The management control not diluted. It may lead to fraud. These are some of the disadvantages of stock dividend. Then to the shareholders, the disadvantages are: it lowers the market value, the shareholders prefers the cash dividend, and EPS also falls. EPS is the profit maximization policy. Expected profit, that also falls. Okay. So we are done with this. So what basically the thing was today, what we discussed today was the investment and dividend policy of the companies, their importance in the financial decision making. Alright. So we are done for today. So I'll just end the class now. The topic is over. So we'll be meeting in the next class. Thanks for your time, both of you. Take care. Good night. Enjoy yourself. Have a great week ahead. And please fill the feedback form which you'll get at the end of the class. Okay? Tamil? Yeah. Thanks for your time. Tamil and Samu. See you in the next class. your next class falls on, with me, I think it's on, maybe on Saturday, if I'm sure, if I'm not wrong. Okay, so bye till then. Good night. Take care of yourself.